Just spent the week talking to emerging markets, and I think the slot machine was a good illustration, because there is a winner and there's a loser in the equation here. If you see rate hikes, then emerging markets are going to be loser again with more fund outflows, and this is the area of the world that accounts for most of the growth so far. So if you knock those growth economies, then where is the growth that we are currently enjoying worldwide?
Well, I think that's a very good point. I would characterise the debate as really the global economy has had a very fragile recovery and it can't cope with any significant US Fed rate hikes. It's a recovery built on lots of debt. It's a recovery with appalling productivity growth. If you look in the US, the productivity growth has basically only been worse once since World War II, and that was the early 1980s. It's a stock market that's going up without earnings growth. I mean, it is a very fragile situation, and that's why the idea of 2 rate hikes this year, I think, would be really quite challenging for global markets.
Does the outlook on rates depend on where markets go as well? I mean, we've seen a market that's come off a little bit in the last week or two. Do you think there is an ability for the market to shoot high if we don't get the 2 rate hikes? And if we do get the 2 rate hikes, is there room for it to move sharply lower into year end?
It makes me laugh. We're sort of in this Mexican standoff. I mean, the markets are watching the Fed and the Feds are watching the markets and the markets are watching, and you go round and round in circles. And really the Fed should be thinking about the economy, which of course on the surface it appears to be. But every time the markets sell off, the Fed and other central banks around the world react. So, I think we're in this, it's this sort of cheap money world. And the markets are sort of almost somewhat holding up the global economy, and more debt creation is sort of holding up the global economy.
Is there something going on within the economy, though, that is misleading economists? Because it was interesting to look at the Challenger numbers, which indicated a higher job loss figure. So I think it was 65,000 as opposed to the expectation of below 50. But you look at the US economy, and clearly there are some sectors that are in retrenchment. The energy sector specifically, which has had huge jobs growth. Should we worry that the jobs being created in the services side of the economy are not sufficiently well paid or of good quality to replace those energy sector jobs that are being lost? I mean, because net, we might not see that in the figure, because the figure might just come in somewhere around the 200,000, and yet there is the change going on below the surface. I
think there is huge change going on underneath the surface. In fact, I would say the US economy is structurally, actually, in some ways quite weak, particularly if you look at income growth by different deciles of income levels. And really, other than the top decile, the rest of the US economies had 15 years of declining real incomes, and that's the problem here, and that's why when the oil price fell, people didn't spend a lot of money, and so on and so forth. I think that's one key change, and another key change going on underneath the surface is productivity is poor, but there's lots of disruption because of technology, which in the long term will be great, but at the moment is not showing up because there's too much debt in the economy.